Good day, fellow investors. So, Jeremy Grantham's GMO just came out with the 7-year asset class real return forecast. What does it mean, real? It means return minus inflation. So, how much are you protected from inflation by investing in stocks versus bonds? And this is a very nice picture that explains a lot when it comes to investing. If you invest into US large stocks or even small stocks, you are likely to lose purchasing power over the next 7 years. 2%, 2.7% per year. So over 7 years, you will likely lose 20% of your purchasing power if you invest in stocks now, US stocks. If you invest internationally in big companies, you will have some protections against inflation. So that is a positive. International smaller companies are a little bit cheaper and should give you a good return against inflation. And then if you look at emerging markets, things look better, and this is because of lower valuations, lower price to earnings ratios. But let's discuss this. What is implied in this 7-year asset class forecast? If we check the S&P 500 P ratio, it's currently at 24.85. That means that the earnings yield is 4.03%. If you get 4.03%, add 2% of growth alongside economic growth, you get at 6% minus 3% inflation, you should be getting to 3% very long term. However, keep in mind this is a 7-year return forecast, so they likely think that the current P ratio will slowly revert to the mean, especially if interest rates are higher, which means that stocks will go down and therefore the negative return. Lower valuations, we are closer to 15 for emerging and international stocks, which mean better returns. So it is a valuation, a PE ratio issue here for stocks and long-term returns. US bonds, now you can lock in 4% if inflation is 2.5% on average over the next 7 years, you get a positive real return. So what they are practically saying that if you have US dollars, this is then different, emerging debt, yes, but currency, and you always run currency risks. If you have US dollars, it's much better to invest in cash, inflation-linked bonds or just US treasuries than to invest in US stocks if you don't look internationally for other investments. So the US is the most expensive market in the world. Even if everything is possible, it is very likely that those investing now in US equity will not reach the historical returns that stocks have been giving for the last 90 years, at least not in a 7-year forecast. So if you are investing for the longer term, okay, but if you are investing for 7-10 years, then you should be very careful how you are managing your money. If you need the money, this is not a bad solution. So just hold your money in cash and keeps your life easy and simple. If you enjoyed this, subscribe, click that like button, and we'll discuss a lot more about investing in the future.